Hello, and welcome to the May 2023 Real Estate Market Update presented to you by the Reedy Homes team. We're going to start off with our local data here in the greater Phoenix area and then move on to some national numbers, so be sure to stick around for that. Let's start with active listings. This graph is from the Cromford Report and shows our listing activity over the last year. You can see last year in April where we were at an all-time low in the frenzy of the market. And then as interest rates began to climb, so did our inventory, peaking at the end of last year in October and November. And then when rates slowly started easing, our inventory began declining and has been declining since. This graph shows listing activity throughout the year. So starting in January and ending the year, that green line is 2019. We're going to take out 2020 and 2021 because we know those years were not normal. The pink line is where we are today and the red line is 2022. So we are up from 2022, but we are down from 2019, which is considered to be a more normal year. So let's take a closer look at those numbers. In May of 2019, we were at 16,425. May of last year, we were at 6,325. And May of this year, we are currently at 10,908 active listings. So our inventory is up about 42% from last year. However, if we compare it to a more normal year, such as 2019, we are still down 34%. And let's take one more look at the month-over-month active listings. In January of this year, we were at just over 15,000, dropped down to just over 12,000 in April, and then dropped again this month at 10,908. So that's down 29% from January of this year and 13% just from last month. Moving on to average price per square foot. This graph goes back to June of 2010, and just notice the trend. Slow and steady increase with some dips here and there until we hit 2020 when the market frenzy began, and you'll see that steep increase, which peaked in May of last year. And then we saw the market adjustment, and that came down a bit at the latter half of last year. And then we are starting to see it pick up again and notice an increase in price per square foot month over month. Taking a closer look at those numbers, in May of 2019, we were at $172 a square foot. May of last year, we peaked at $306 a square foot. And then we saw the market adjustment at the end of the year in 2022, and we are now at $284 a square foot. And let's take a look at the month over month numbers for price per square foot, starting in January of this year at $271 a square foot, bumping up to $273 in February, up to $279 in March, up to $282 in April, and now up to $284 this month. Although small, it's still 5 consecutive months of appreciation, despite interest rates not being the most favorable. Part of that can be attributed to the fact that we still have very low inventory. Because a very large number of homeowners have an interest rate of 4.5% or lower, that means they have a very affordable monthly payment, and a lot of homeowners are not going to want to give that up if they don't have to. So if inventory does remain low, which it is expected to do, and the Fed decides to give some relief on interest rates, that'll increase buyer demand. And what will happen to prices if demand increases and inventory remains low? Well, I think it's safe to say in that event, we would see some upward pressure on prices. And that'll wrap up our local data. Now let's take a look at what's happening nationally.
Jumping right into the first topic, home prices. This quote from Doug Duncan with Fannie Mae is an interesting turn of events. On a quarterly basis, home prices rose as seasonally adjusted 1% in the first quarter of 2023. The fact that prices rose slightly in the first quarter is evidence of significant pent-up mortgage demand despite ongoing affordability constraints. A look at the leading indicators that measure month-over-month home prices suggests there's a case to be made that the decline of home values have begun to stabilize or perhaps even stabilized. This look at Case-Shiller, FHFA, and CoreLogic month-over-month prices from January 22, we see the year started very, very strong, and then around the middle of the year, home prices month-over-month started to slightly decrease, much of that due to the rising mortgage rates. Then fast forward to the latest information, February, in FHFA and Case-Shiller's case, and then March for CoreLogic, it shows home price declines might be in the past. Comments from Black Knight puts this into perspective as well. Just 5 months ago, prices were declining on a seasonally adjusted month-over-month basis in 92% of major U.S. markets. Fast forward to March, and the situation has done a literal 180, with prices now rising in 92% of markets from February. Well, that's led to forecasters adjusting their projections. Fannie Mae's forecast in March of 22 was a loss of a little over 4% in value in homes nationwide. March of 23, they adjusted that to maybe a 1% value loss. Moving on to inventory and foreclosure, one of the reasons for the positive movement in prices is because of the lack of inventory. And this graphic, well, it sums it up. This is a look at buyer's market versus seller's market. We went through the 2008 crisis and inventory rose resulting in a buyer's market. Over the last several years was a strong seller's market, and even with the price declines, we're still in a seller's market today. Headlines continue to suggest that inventory is going to rise with a flood of foreclosures coming onto the market. While some of the headlines, they're factually correct, they can also be misleading at the same time being factually correct. Now, what's missing from these headlines is the comparison to the actual normal years, so the years prior to 2020. There were over 1 million fewer foreclosures in the last year than the average years heading into 2020. It's important to look at 2017, 18, and 19. Those were the last 3 normal years. The average of foreclosures in those 3 years, 598,000 foreclosures. After the COVID moratorium, those numbers dropped through 2020 and 21, and now coming out of the moratorium, the expectation is that foreclosures will rise, but not at a rate that would impact inventory and cause a shift into a buyer's market. Look at U.S. properties with foreclosure filings back to 2005. Shows a rise in 2008 during the housing crisis, over 9 million foreclosed or distressed properties. Today, there's just a slight tick up, but nothing like what the headlines are claiming. Another topic of interest is how might housing be impacted by recession? Bankrate sums this up saying during a traditional recession, the Fed will usually lower interest rates, and this creates an incentive for people to spend money and stimulate the economy. It also specifically leads to more affordable mortgage rates, which leads to more opportunity for home buyers. Looking back at the last 6 recessions shows that 4 of the 6 times home prices appreciated. Twice they depreciated, once marginally in the early 90s. But what everybody remembers is 2008 when homes lost almost 20%. Looking at those same 6 recessions, it also shows that each time mortgage rates fall, and this is going all the way back to the early 80s. The understandable concern for many folks is related to that 2008 crisis. So it's worth looking at the major factors from then and now. First, the current rate on existing mortgages, according to FHFA, as of the fourth quarter of last year, the majority of those mortgages are below 5%, and over 80% of existing mortgages below 5%. Over 50% are below 4%. Those loans, people are going to work as hard as they can to keep that mortgage. And the second thing to look at is homeowners are sitting on a tremendous amount of equity. 67, almost 68% have either paid off their mortgage or have at least 50% equity. 38.7% own their home free and clear, and 28.9% have at least 50% equity. Together, that's almost 68% are in a position where they either have it paid off or have 50% in equity. That's an extremely strong foundation for homeowners. And back in 2008, people walked away from their homes because they literally owed more on the home than what it was worth. And that's not the case today.
Well, that does it for our May 2023 real estate market update, both locally and nationally. As always, if you have any questions about data in your specific area or just questions in general regarding real estate, please don't hesitate to reach out. We're happy to help. Thanks for tuning in, and we'll see you next month.